So here we're in the same scenario. People see the music coming to an end. There's a bear market on the horizon. We're in bubble phase. So people are moving in here for safety and defense. But eventually we're going to have a bear market, a stage 4 correction, and it'll most likely pull gold back down fairly sharply. I believe you'll be able to buy gold where it is now, or potentially back down around this 2000 mark, potentially 3, 6, 9, 12 months from now. But after that, then we go into the multi-year rally, a 3, 4, 5-year rally in gold, which will send it up to, who knows, 3,500, 5,000, whatever it goes to in the future. It'll start that next big move. This is the opportunity where I see miners becoming a very exciting place.
Since 2020, gold has risen by over 50%, positioning it as one of the top-performing asset classes in the market. Gold prices saw gains in morning trade in the domestic futures market on Wednesday, July 3rd, tracking positive global cues ahead of the minutes of the Federal Reserve's last policy meeting, which may give hints about when the U.S. central bank may start the rate-cutting cycle. ChrisVermeulen has been involved in the market since 1997 and is the founder of Technical Traders Ltd. ChrisVermeulen sees gold as a critical indicator due to its stability in volatile markets. Despite short-term volatility, he predicts a multi-year rally that could push gold towards $5,000. Based on his observations, Vermeulen sees parallels between today's market and the early 2000s, indicating a new supercycle for gold and precious metals. A few months ago, gold completed what in time will be viewed as the biggest gold breakout in 50 years. It does not get any bigger or more significant than a breakout from a 13-year cup and handle pattern. The implications are incredibly bullish over the next few years and the next decade. From a technical viewpoint, Vermeulen suggests that in a bear market, gold will initially drop but stay safer than stocks. He highlights the opportunities in gold miners and uranium stocks, expecting them to bottom out before the broader market, much like past trends. Despite gold hitting several all-time highs, the gold miners have still not rallied that strongly. Currently, the VanEck Gold Miners ETF is only up 10% year-to-date. Now we present the clips of ChrisVermeulen's insights from his recent interview with Capital Cosm. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
We use gold as the barometer because I find it's the most accurate to trade, most accurate to kind of track. But silver and gold miners, you can say, are kind of the same trade. So right now, like, I think 2019, I think, was the start of a new super cycle for gold and precious metal space in general. And we've had a rally up. It's been consolidating. I think it's very similar to the setup that we saw back over here in terms of the new bull market that started back in 2003, 2004. And then the market kind of runs up and matures. And then we saw it consolidate for a couple of years, 2005, 2006, 2007. And we've just had a very similar consolidation, a multi-year pause. And then what happens is, back over here in 2007 and 8, we saw gold start to take off. And that was because people start to see, savvy investors say, hey, there's chaos coming. Businesses are going to struggle. Stock market crash could be coming. They want to move to a different asset, something that's slower. As you just said, Danny, gold falls a lot less than the stock market. So it is a better play. If you're going to hold something, better hold something that's not going to fall as fast. Although I don't recommend holding anything that's falling. But we see money move into the precious metal space. And then in 2008, we had the crisis and gold pulled back 34%, which is a lot less than the 54% the stock market did. And so here we're in the same scenario. People see the music coming to an end. There's a bear market on the horizon. We're in bubble phase. So people are moving in here for safety and defense. But eventually we're going to have a bear market, a stage 4 correction, and it'll most likely pull gold back down fairly sharply. I believe you'll be able to buy gold where it is now, or potentially back down around this 2000 mark, potentially 3, 6, 9, 12 months from now. But after that, then we go into the multi-year rally, a 3, 4, 5-year rally in gold, which will send it up to, who knows, 3,500, 5,000, whatever it goes to in the future. It'll start that next big move. This is the opportunity where I see miners becoming a very exciting play. Same with uranium stocks. It'll be just like over here. We'll probably see precious metals and miners bottom months before the stock market. That's what we've seen in the past. So there's all these things to watch for. The key is this is a monthly chart. So just looking at that chart, we still need like another 5, 6, 12 of these bars to build this out. So that's still a year out. I know people want stuff to happen right now, but we're talking like, 10, 15-year super cycles here. They take a while to unfold, but if you patiently wait, you get in at the right time, man, you can make some serious returns. And knowing this is coming should be peace of mind. And I still think gold's going to rally to 2650, 2750. I still think we're going up here, but I think it is going to come back down with the markets, just like it did in 2008. It'll get sucked down with the forced selling, liquidation. I remember back in 2008, I was heavy into the precious metal space. That's what I really focused on, was gold and oil. And people who absolutely loved gold and had been accumulating it and buying it had to sell it. I remember the emails coming in. They're like, everything's falling apart like I expected, and I have to sell my gold. I have margin calls because my stocks are falling, or I lost my job and I have to sell my asset I've held forever. And that's the problem, is people get in a bad financial situation when these financial crises hit, and they have to sell their favorite positions, gold and silver, and they get pulled down with the market.
During the interview, ChrisVermeulen points out that unemployment has risen above the 24-month moving average, historically indicating a financial crisis. He predicts that the market will enter a significant recession as unemployment increases, similar to previous crises like the tech bubble and the 2008 financial crisis. The latest employment data is providing further momentum for the gold market. The gold market is holding solid gains above a critical resistance level as the U.S. labor market continues to struggle, as the number of American workers applying for first-time unemployment benefits is elevated. Initial claims for state unemployment benefits rose by 4,000 to a seasonally adjusted 238,000 for the week ended June 29, the Labor Department said on Thursday. Jobless claims rose in line with economist expectations. Furthermore, Vermeulen foresees short-term gains in gold, silver, miners, and energy stocks, but predicts an imminent recession. He points to companies cutting earnings and rising unemployment as key indicators of an approaching market downturn. If history repeats itself, a recession would be even more damaging to the markets than previous recessions. Let's get back to the interview.
I think there's a lot to kind of cover there. I think there's some good opportunities in the resource space. I really still like gold a lot. I think investors need to know we're on this last kind of leg of the market. Let me actually just show a chart here of the market cycles, which this is really important. So this bluey gray cycle here is the stock market. The yellow one is the economic cycle. And when we get close to a major market top, a major bull market, which is where I believe we're at, we tend to see gold, precious metals come to life. Gold's trading right up near all-time highs. Energy stocks are trading right up at all-time highs if you look at XLE. And then industrial capital goods are doing very well. And when these all come together and start to hold up and outperform the stock market, then we know we're in this last kind of final leg. And I believe there's upside in gold and silver and miners still for another month or two. Same with energy stocks and oil. Industrial capital goods, I think XLI and the industrials, I think it actually still has some upside for only a couple of months. And then I think we're going to start to see things roll over and sell off, because I think the recession is coming. I saw somebody talking about how they think the SP 500 has peaked its earnings. Companies are now trimming, laying off, cutting sales forecasts, all those things. And so I think that's kind of the early warning sign of the market. So from a asset point of view, we are right at the top of the market. And if we were to look at it from a more of an economic stand, we can look at this 24-month moving average of unemployment. Every time we have this red bar is whenever unemployment moves above the 2-year moving average, we have a financial crisis of some sort. The 2008 crisis, the tech bubble, the pandemic, and we just crossed that again. So we're in this phase here where unemployment is starting to rise. We have the government creating all kinds of jobs. This is a percentage of total job openings. And we've seen this in the past. The government is always trying to mask and make the economy look better than it is. They don't want people to panic. They open up, they create all kinds of jobs. And even as they're creating jobs, the market goes into a major recession, the tech bubble, the crisis, the COVID. And here we are, they're creating all kinds of jobs again. Yet unemployment keeps going up, even though they're creating more jobs. And when you kind of take all of that and look at it from how many jobs are being lost, we're actually starting to lose jobs, like full-time jobs. It's not just people getting hours cut. It's actually like, no, you're done. Here's your severance. You're out of here. So these always happen. I mean, things are turning. So both the technical charts are saying things are breaking down, and the economic data shows it's breaking down. I don't look at the ratios at all. I mean, yeah, the gold silver ratio is saying silver's a buy right now. I think silver's always going to outperform percentage wise, but I think you definitely need to wait for the right time. It's really volatile. I mean, it pulled back over 60% during the 2008 crash. So, that is a pretty severe pullback for most people to hold. I like gold because it's more stable, it's steady. Silver is definitely more of a speculator's play. It's a smaller market. If it has more speculators, it has more emotions, which means things get overbought and they get oversold. And that's what creates these massive swings that are hard to stomach for a lot of people. But we're seeing, same type of price action as gold. Silver rallies up before a bear market. Silver is rallying up right now before what I think is going to be a bear market. And you'll be able to pick it back up, 24, $20 before it starts that blast off to $50 and beyond. I mean, I think one of my targets is like $82 or $87 for silver, depending on how you analyze it. So there's tons of upside, but it's going to be a little bit of a rough ride, I think, still. For the space. I do think silver could rally to about 34 or 36 an ounce before it starts that pullback. So there's still percentage wise potential some good moves to the upside in silver still.
Gold is forming a bullish monthly pennant. Bear in mind that experts commonly recommend allocating at most 10% of your portfolio to gold and other precious metals. Bank of America Corporation analysts project that gold could soar to $3,000 per ounce within the next 12 to 18 months, driven by increased non-commercial demand and potential Federal Reserve rate cuts. Given the current economic indicators and historical patterns, how are you adjusting your investment strategy to prepare for a potential market downturn? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.